Josh, let me ask you first, what did you think when we saw this news come across the Bloomberg terminal this morning? Were you surprised?
I was surprised with how assertive and explicit Ms. Lagarde was, but I think in this issue, as with many others, where you stand really depends on where you sit. And the IMF has a different role. They're looking at different issues they're looking at similar issues from a different angle from the Fed, and I think that really shows. They're looking at the downside risks, and that's really what they have to emphasize. And it's not the first time they've done that, even this year.
And I just want to ask quickly, because you used to work with the good people at the Federal Reserve Bank. How do you think they took this?
Well, I think it's always frustrating when you find yourself in the public eye and you feel that you're being criticized, even when you're doing your best.
In the public eye? The Fed? I mean, come on, that's what they do.
That's what they do, and it's a tough job. But, you know, you always want to, what people don't see is the hard work that's going on behind the scenes and how carefully people work there to weigh the dual mandate on the monetary policy side plus this new mandate for financial stability and how complicated that makes their work.
Lisa, I want to ask you, what in heaven's name did anybody think would be accomplished by having the IMF basically tell the Federal Reserve and all of U.S. policymakers that they should not raise rates until 2016?
Well, to Josh's point, politically it looks good for them. We're looking out for the little guys. We're looking out for the emerging markets. You know,
why don't they spend their time on Greece? What are they doing telling the Federal Reserve what they should and shouldn't do? This is not part of their mandate.
My colleague, Katya Portugansky, who covers emerging markets, made the very astute point. IMF does this with all countries except for the U.S. all the time. This is what they do. The U.S. just isn't as accustomed to it because we're the behemoth and we're not as used to it. So, I mean, I think that this is what they're accustomed to doing. They go out and they tell people, or they tell countries, this is what you guys should do and this is what your growth outlook is going to be. But we're not as used to them doing it to us.
Eric Green, if you were short bonds, this was not a good day for you, right?
No, not at all. But I would be quick to emphasize that I think the big turn that we saw in the bond market this morning has very little to do with what came out of the IMF. I think Bunds wanted to get to 1%. They got to 1%. And I think a lot of buyers actually came in and saw that as an attractive opportunity. You know, my own view on the IMF is honestly, I'm not all that surprised. I think Josh made a great point. You know, the IMF has a very different mandate. It's a global mandate. The U.S. has a much more of a domestic mandate, obviously. And, you know, the reality is I'm sympathetic to the argument that you don't need to raise rates this year. After all, we don't have too much growth and too much inflation. That's obvious. But, you know, her comments miss the joke in terms of what's going on at the Fed and why they want to raise rates in the first place.
I actually thought there's a conspiracy theorist lurking inside me. And my first thought was, oh, maybe, you know, because Janet Yellen and Christine Lagarde are friends, they WhatsApp with each other, and maybe, you know, Lagarde is giving Yellen the out that she needs. She's been promising to raise rates this year, but nobody believes her. And
Lisa,
the market
doesn't
price it in, right? So maybe this is the out that she needs.
I don't think she's looking for an out, though. I think whether or not the Fed should be raising rates, even if they shouldn't be raising rates, they should be talking about raising rates, because their whole job is to prepare the market. And that's really the anxiety that Christine Lagarde's comments reflect, that she's concerned that the market won't be prepared for this. And this is what she was talking about in April, and the Fed brushed it off then. And the Fed has to try and prepare the market for rate hikes, even if they don't end up occurring.
But the Fed has been planning to raise rates and just step away from its monetary stimulus for years. It's been trying to get there. How is it going to ever move past this? I mean, will inflation suddenly start ticking up enough in the first quarter of 2016 to make everything seem copacetic? Right now, people have been pushed into crowded positions. You have herding kind of behavior in certain types of bond funds. This is concerning all of the regulators. Is the answer just to prolong this environment forever?
Let me ask, Eric, let me ask you one quick question. We were talking with Guy Labat this morning. He suggested that Janet Yellen might raise rates just 5 basis points or 10 basis points. Do you think it's possible that we see such an unconventional hike?
No, I think the odds there are very low. I think they are going 25. But, you know, that was a good point that was just made. You know, when the Fed is trying the Fed knows one thing. That is that when they raise rates, they don't know what's going to happen. And Ms. Lagarde made a good point that there is issues of financial instability, but that's going to be prevalent no matter when they raise rates. And to the point that they've been grooming the markets for a rate increase for 1 year, this is heavily socialized. Now, I think that when the Fed is looking at all this, they aren't thinking, well, what are the economic conditions in the first half of the year? or even in the third quarter. They're benchmarking where inflation and growth is going to be 6 to 12 months from now. Even the IMF says it's going to be 3% growth, and I can tell you with near certainty that we'll have headline inflation in the U.S. in January at about 3, maybe even 3.5%. So, I think that quite contrary to the tone of the discussion this morning, when we come out of the FOMC meeting in June, I think that the bond market is going to have a massive wake-up call, because I don't think that the median dots are going to be shifting lower. I think the prevailing bias will be 2 rate hikes. And in June, with only 6 months left after such weak growth, that is something that the market cannot dismiss.